Welcome back to another tutorial session with Grand Majors Academic Support Services. Today we'll be looking at inventory valuation, but more specifically, inventory errors, right? But just to reinforce a few key points that we would have gone through before. When we speak to inventory valuation, we talk about inventory accounting systems, and what these are systems that tells us how cost or shows us how costs are assigned to inventory. There are two types of these systems. We have the perpetual inventory system and the periodic inventory system. Under the perpetual inventory system, we have different methods in which it is valued. The first one, we have the first in, first out, FIFO method. Then we have the last in, first out, LIFO method. And we have the average cost or the weighted average method, right? So that's the perpetual system. But what I'm going to ask you to do is to drop in the comment section, what do you think or what you should know, right? What the periodic inventory system speaks to. Tell us in the comment section below, right? And an important concept, accounting concept that I want to bring across again is the consistency concept, because it relates a lot to inventory, right? And it speaks to choosing a specific inventory method, whether it be the perpetual inventory system or the periodic. And if you're choosing the perpetual, either you're going to stick with the first in, first out, or the last in, first out, or the average cost method. So sticking to that method for the entire year, for the entire period, unless there is a good reason to switch, unless there is a good reason to change, right? Because we must disclose the effect of changing. Why did you change from this method, and what effect did this have on net income? Because using either method fluctuates your income. Some make your income more, some decrease income, and you could go and watch our previous video to see that, right? So these are just a few key points that I wanted to point out before we turn our attention to what we're really focusing on in this video, which is inventory errors. So you might ask, what is this, right? So inventory error refers to an incorrect entry or calculation in arriving at one's ending inventory balance, right? And we know beginning inventory plus what you purchased minus what you ended the year with, what you have left, right? We know that formula, right? So it's an incorrect calculation in arriving at that balance, right? It affects two consecutive accounting periods, assuming that the error occurred in the first period and is corrected in the second period. And why we say this is because, an example, we made an error in 2020, right? If this error is identified and corrected in 2021, we're seeing that, okay, in 2020, something was wrong. We have to correct it in 2021, right? I said 2020 before. If it occurred in 2020, we corrected in 2021. So therefore, both those years will be out of balance because we had an error in one and we're correcting for an error in the prior one. However, if this is not identified or corrected any at all, this error, right, continues until it is identified and corrected. So that's why we're saying it's two consecutive accounting periods. The period that was initially wrong, and then the following period in which you acknowledge it, you found it, you identified it, and then corrected it. And as I said, if we never find it, if we never correct it, this will continue on for years, right? So the reason that an error in the first period changes the ending inventory number is because we use ending inventory to calculate our cost of goods sold, right? And not only that, ending inventory is in our balance sheet, in our current assets, right? And essentially we take ending inventory, goes down into our profits, and it affects a lot of stuff. But an important principle to remember, right, when dealing with ending inventory, remember that your ending inventory for 1 year is your beginning inventory for the next year. So we're seeing why this justifies it affects two consecutive periods. This is a running balance. You carry it on and on and on and on. So if we make an error in one period, it will affect the following periods, right? So as we said, ending inventory impacts cost of goods sold. Subsequently, cost of goods sold affect gross profit and net profit. Those figures are carried onto your balance sheets and your statements of owner's equity. So it has a big impact, right? But what I want to turn our attention to for a small bit, because the question that we're about to do, it asks this. So if revenue is constant, right? If your revenue doesn't change and your cost of goods sold increases, this means that your revenue will decrease. Remember, your cost of goods sold is how much it costs to sell these goods. So if it's costing more to sell goods where the price isn't changing, your profit is going to decrease, your revenue is going to decrease. But if you can reduce your cost of goods sold, right, your revenue can increase. All right, so if constant revenue on changing revenue, if cost of goods sold increases, revenue decreases. Constant revenue, if cost of goods sold decreases, the revenue will increase. But let's look back on inventory. So if inventory is understated, meaning it should have been 35 and we have 30, it's less than what it should be. We wrote down the wrong figure. If it is understated, right, or cost of goods sold in the current period would be overstated. And when we would have identified and corrected in the next period, it would be understated. So here we're seeing, okay, overstated, understated, it cancels out, it balances out each other for the next 2 years, which is why it's 2 consecutive accounting periods. If we identify and correct it immediately, right? And the opposite is true. If inventory is overstated, cost of goods sold in the current period would be understated, but overstated in the following year, canceling out each other after 2 years. So let's look at a question, right? Van Dyke, copy your inventory data for the year ended December 31st, 2008 is as follows. We have sales revenue, 50,000, cost of goods sold, and we're seeing how we arrive at cost of goods sold. The formula for cost of goods sold, begin inventory plus net purchases gives us cost of goods available, what we have to sell. Then we have your ending inventory, what is left, right? Subtracting that from what was available, we get the cost for what was sold. And from sales revenue, we subtract that and we get our gross profit. So we have a gross profit here of $23,000. What is this question asking us to do? It says, assume that ending inventory was accidentally overstated by $1,000. What are the correct amounts for cost of goods sold and gross profit? Then part B says, how would the inventory error affect cost of goods sold and gross profit for the year ended December 31, 2009? So how would this inventory error affect cost of goods sold and gross profit for the following year? And this is why I had pointed out just about that constant revenue, because here in the question, it didn't say revenue changed. So we're still keeping our $50,000 revenue. Our revenue is constant, but we have a change in our cost of goods sold. We have a change in our ending inventory. If we have a change in our ending inventory, our cost of goods sold figure is gonna change as well, right? So we're gonna use what we would have talked about before to see how would this change in ending inventory and subsequently cost of goods sold. What would that look like for profit in the following year? All right, so let's talk it out a little bit more. I know we were doing that before, but let's go a little bit further before I give you the answer. So here we have the information. Sales revenue is fine. It says beginning inventory is fine at 42, but ending inventory was overstated by 1,000. What we have here as ending inventory now is 4,600. So if it was overstated, it means that it's too much, right? So the correct amount for ending inventory should be 3,600 instead of 4,600, right? So now keeping our same sales revenue, beginning, net purchase, all of that, keeping all of that. What we now have to do is now to subtract our new ending inventory figure, 3,600, from our cost of goods available, right? So now or cost of goods sold is not going to be 27,000, but 28. So here, that same principle. If it was overstated, if your ending inventory was overstated, right, your cost of goods sold would have been understated, right? Because here it was overstated and it's 27,000. The right figure, 3,600, give us the right cost of goods sold, 28,000, right? And essentially what our ending inventory tells us is that this is what we have left. And if we have less, it would mean that more goods were sold. It would have cost more to sell the goods, right? So if our cost of goods figure changed, subsequently, our gross profit figure would also change. So our new gross profit figure would now be $22,000, right? So another point that I want to reinforce, if there is less ending inventory, as I said before, it means that more goods were possibly sold. Thus, cost of goods sold would increase and our profits would decrease because our revenue didn't change. With constant revenue and increased cost of goods sold, your profit is gonna decrease, right? So to answer this question, what are the correct amounts of cost of goods sold and gross profit? Gross profit would have been $28,000 as we saw, and our cost of goods sold, would have been $28,000 as we saw. Let's look back at it, and our gross profit would have been $22,000, right? So let's now turn our attention to part B. How would the inventory error affect cost of goods sold and gross profit in the following year, in 2019? Because this information that we have is 2018. So what is the impact for the next year? So let's turn our attention back to our key points that we started with, right? Remember, inventory was what? Overstated. So our cost of goods sold the following year, that's what the question asks, the following year, 2009, would be overstated, right? And if our revenue is overstated, if our cost of goods is overstated or increases, it means that your revenue would decrease, right? So that answers all the questions for this simple question. Simple, and I hope that I also made it as simple and easy as possible for you to understand. But if that wasn't so, and if you have any other question, remember, you can always drop it in the comment section and we'll sure to answer. If you don't want to do that, you can always reach out to us at Grand Majors on Instagram, or you could email us grandmajorsacademic@gmail.com. But what I'll ask you to do, if this video assisted you in any way possible, give us a thumbs up, like this video. If you know of anyone who needs this material, who's doing the course, who'll be doing the course, share it with them. It's free information. Knowledge is here for everyone. And also remember to subscribe to our channel to help grow our channel so more videos like this can be produced. So until next time, enjoy the rest of your day. Thanks for watching.